think it certainly makes things hard. I mean, one of the ways we're looking at it the moment is that with all of that political uncertainty that's out there, it just makes sense to be taking much smaller bets. So actually we're getting closer to neutral pretty much across the board because of the uncertainty, both, as you say, in the UK around the Brexit negotiations and then globally when it comes to the trade concerns around China and the US.
Okay, so you factor in your models then. How much of a variance would there be, say, in the EU or UK, depending on either of the outcomes? Or is it relatively similar in terms of your investment perspective?
Well, I think actually the markets and the media are somewhat overdoing the chance of there being a no-deal Brexit. To us, it seems very unlikely that you'll get a no-deal Brexit. It would just be too damaging for the UK economy, and it would also hurt the EU, although not by as much. And there's just not support in the House of Commons or indeed amongst politicians in Europe for a no-deal Brexit. And for that reason, we think it's unlikely to happen.
Well, let's hope that you're right, obviously, but human beings have certainly made mistakes in the past. Whether or not it's a mistake or not, I don't know, but they've done unexpected things either way. So when you put pen to paper and you look around the world for your clients, give our viewers some of your best global investment thoughts and ideas and themes right now.
Well, I think when you look at the global economy at the moment, still it's a relatively sunny picture, particularly in the US. You've got strong consumer confidence, you've got businesses telling you that the outlook's pretty positive. For the moment, things still look okay, but we think the clouds perhaps start to build once the economy heads beyond 2019. And we're therefore in a mood to sort of start preparing for that. I think the key investment conclusions for that are increasing weighting to alternatives that have the ability to reduce their net equity exposure as troubles start to build. I think also within fixed income, you need to be quite dynamic, have strategies that are able to reduce their credit exposure as recession risk gradually starts to build and to increase duration as we get closer to the turning point for the economy. And then within equities, I think the key things are you don't want to be overweight mid and small cap equities if you're getting towards the end of the cycle. I think you also, historically, you tend to see that growth stocks underperform during downturns. So we're shifting more towards value. And then the final thing would be quality stocks. Historically, quality stocks have tended to outperform consistently during downturns. And so we're starting to shift more towards a quality bias within portfolios.